Billions to Become a Better Investor, episode 34, 4 months of 2023 to go. Hello, yes, we've entered a new month, so that means that 8 months have now been completed of 2023, 4 to go, if my maths is correct, and kind of where are we now? 2/3 of the way through the year. It's been kind of interesting as an investor. I think many investors have found that equities have been difficult, maybe because they're a little bit more mid-smaller cap centered, but in the larger cap, global, international world, it's been far from impossible. In fact, I guess the ideal investor would have had a whole allocation to the technology sector, particularly in the States, but generally across the world, and that would have been fabulous. But obviously, they would have had to been smart enough to make the switch into technology at the end of last year, because, of course, that was a sector that had an awful time in 2022, whilst, of course, other areas did rather better. So, as always, you've got to be an active, evolving investor. For myself, as I've been talking about over recent podcasts, I've been shifting around my technology exposure a little bit, but it's certainly not the biggest part of my portfolio. In fact, it's kind of interesting. 2023 has been, I think, quite an interesting, proper active investing time period. And it's kind of, in a way, August was a disappointing month in the sense that markets generally were down, global equity markets. Bond markets also were generally a little bit negative, and that continues their lackluster at best performance so far in 2023. You have been smarter to have been an equity rather than a bond investor this year. But overall, August was a slightly disappointing month, certainly with reference to performance numbers if you look over the previous couple of months. So I guess, as always, people have entered September in the back to school, oh my goodness, what should we be thinking time period. And September is always a fascinating month for thinking about markets and thinking about investment choices, because certainly from an institutional investing perspective, it is the second most important period of time in each year, where people have presentations and talk about strategy and the like. Frankly, the only timescale more important is that classic sort of December, start of January kind of comment on what are the thoughts for the upcoming year, etc. It's interesting, isn't it? We talked in previous podcasts about how August can be a tricky month for investors. If you like, people away, lack of volatility, small issues suddenly becoming perceived as big negative ones, etc., etc. There was obviously some interesting updates, not so much on the corporate results season updates, a bit more on the sort of macro geopolitical angle, but even some of that was, I thought, quite workable. More indications, of course, of lower inflationary impacts, and hence scope for a movement of general central banks, the largest central banks of the world, to stop raising interest rates seems to be made further progress to me. As you know, I would have stopped if I was the Federal Reserve or the Bank of England or the ECB. I wouldn't have made the interest rate increases that they made over the last couple of months. I'd have passed on those and sort of waited to see how things pass through. But there you go. What was kind of interesting, of course, was that we had a little bit of geopolitical angst. Not so much. I talked in a podcast a couple of a week or two ago about the expansion of the BRICS. Now the BRICS Plus are upcoming to be the BRICS Plus grouping, which I think is more of a positive than negative. Kind of interesting to see in the upcoming G20 meeting in sort of mid-ish September, so in a week or so's time, as I speak, in India, that Xi Jinping won't be turning up, which is kind of interesting. But I've read somewhere else earlier today, as I speak, that Xi Jinping and Vladimir Putin are likely to meet, which I'm sure will lead to lots of skepticism of people and everything else, but kind of again indicates that G7, G20, it's not as sort of neat a grouping as perhaps history would have shown. So, an evolving world, let's put it that way. Not an impossible world, though, at any means. And certainly when I think about the balance of this year, I'm still actually pretty optimistic. I'm optimistic because I think more people will get their heads around the notion that inflation is coming down. Central banks are going to stop raising interest rates. I'm surprised I haven't done that already, but I think that'll be a lot clearer over upcoming months. And consequently, I think it's likely that some of the sort of the fear factors will start to dissipate. That's not to mean, though, of course, that we're not going to see some tricky lack of growth numbers. And I'm sure there'll still be those saying, as they did at the start of 2023, that a recession is inevitable in a bunch of both developed and some developing markets too, let alone ongoing geopolitical challenges, Ukraine and Russia, matters with China and related. I think that all continues. My guess is, though, is that the world is clearly at a point where growth is going to be positive, but it's not going to be mega positive, not going to be amazingly positive. And so consequently, that importance that we saw patently clearly from the corporate earnings season, that your choice of investments matters an awful lot more than it did maybe in the 2010s, certainly, is much more apparent. That's something which I've said about 1,001 times so far this year, so no great surprise I'm not changing my mind there. But it is interesting, isn't it? And I saw it in some numbers that I was following in the sort of the either very late earnings season or the numbers which come at different times of each quarter, which, some companies do have slightly different timings than the vast majority of other names. And it was fascinating how pricing power is not a sort of a neat subject. It's not that, a company which is in a certain sector or is a certain size or maybe appeals to richer or mainstream customers or whatever is doing better, because that's patently not the case. It's much more specific matter than perhaps investors have seen for much of the last 10, 12, 15 years. Again, it reminds me, point I've made about, again, a number of times before, it does remind me of that some of my early investor days particularly in the 1990s, where you really had to be more careful, where qualitative appraisal became much more important than just was a share from a macro or a quantitative perspective cheap or expensive. Choice of sectors becomes less relevant. What becomes more important is choice of companies and broader asset allocation choices, the role of those aforementioned macro and related matters. It still remains that sort of world as far as I can see. So therefore, not overly surprised by slightly mixed markets in August, not overly surprised to see a few people now worrying about what are we going to be thinking about the rest of the year. But as always, you've got to be greedy when others are fearful. I see that the Fear and Greed Index, which, as you know, I look at quite a lot, is interestingly pitched at the neutral zone at this moment in time, at the time of speaking. And I find that kind of, again, indicative very much of an active investing backdrop. I think, frankly, there are certain areas out there which are overloved and some which are underloved, as is the case, as you would always expect in an active market. I think macro matters, as I say, I think interest rates are going to stop going up, which I think will be taken as at least a small positive. However, growth issues, as you can see, certainly also by slightly lower job creation, will be having inevitably a little bit of a negative impact. Companies, as per the corporate earnings season, it's a much more of a specific set of risks out there. Some are doing okay, some less well, but it's not impossible out there. That still remains my broader conclusion. Far from impossible out there. That's why I would still expect equities to end 2023 as clearly being a better source of return than bonds or general fixed income allocations, be it corporate or government. But I think that latter grouping will probably move a little bit more into sort of from generally small losses so far year to date into sort of more neutral stroke slight gains. So ultimately, if you're a general investor, is it smart to hold loads of cash? The answer is still no. I think, frankly, as always with investment, some of your bigger movements and bigger returns occur just that moment in time when you least expect it. As always, the darkest hours before the dawn and all of that. I still think you've got to remain clearly allocated as an investor. That is still smart. And we've talked before about my link between your age and your allocation to equities versus bonds, but also actually, frankly, the lack of rationale for lengthy, large cash holdings, and a preference, if you are going to do something as an alternative, still stays with gold for me, which actually has performed reasonably well in the last week or two. And again, I think as an alternative allocation still makes a lot of sense to me, much more than things which I understand a bit less, such as Bitcoin. But hey, choices was always between many ultimate alternative asset classes. Still think sector and stock analysis and appraisal matters hugely. I talked in a podcast a couple of weeks ago about some of my favourite sectors out there. Certainly finding a lot more interest in pharma, selected parts of consumer, industrial, and what I would regard as some of those alternative sectors, facilitation, as I've wonderfully called it in a previous podcast or two. So I think some of those are more interesting than maybe allocations to technology, elements of the financial sector and related to, on average. Saying that, kind of interesting to look at the update from the Prudential, now largely centred in Asia as an insurer and relative fund management allocations. Still remains an interesting company in my regard, and perhaps some other time I'll talk a bit more at length about that. But certainly their numbers in the last week I thought were more than workable, certainly for any investor from a medium-term allocation perspective. So an interesting backdrop out there. Not impossible. I'm so excited about quarter four. Still, of course, inevitably thinking about what 2024 will bring us. It's a bit too early to talk about that at length, but just the fact that we've got some mega elections coming up, not just either side of the Atlantic, but also, most interestingly, of course, in Taiwan in January for starters. Clearly discussions, if you broaden it out a little bit in East Asia about the Chinese economy. I'm not as pessimistic. There are some people who are talking about, oh my goodness, we're going to see growth rates way below the 5% indicative level hoped for this year. China is still growing. It's not just not growing as much as it matures, and probably some policy errors made. Frankly, Xi Jinping, if I had to advise him, I'd say the smart thing to do is to focus on trade. Hence, good to see more discussions ongoing, albeit that, as always, progress has not been phenomenal. But good to be talking, good to be participating fully, nicely, as discussed about the BRICS plus expansion, but in other parts of generation conversation, at least, if not a huge amount of progress. I would also observe that actually, and it's kind of most indicative, I think, really by companies such as Alibaba, which, as I've talked about, full disclosure, did increase my allocation a couple of times over the last few months to the company's share exposure. And it's kind of fascinating to see the split occurring there, the six-way split potentially, and I think that makes an awful lot of sense. And to me, I think that's a small realization that actually some of the common prosperity driven shifts over the last couple of years aligned with some probably what I think most would regard as overly lengthy periods of COVID lockdown in China, has hence made that kind of hoped for recovery in 2023 more patchy than anticipated. I know people are talking about, well, it's pretty obvious, isn't it? It's look at the housing market in China, look at the multiples there, and the clear scope for oversupply and too much debt. Frankly, name me a country in the world which doesn't have house prices which are a bit too high and debt levels that are a bit too high. I guess most of them probably wouldn't also have Chinese growth levels, which I think gives China a little bit more flexibility, even though, as I say, obviously any country which is not fully adhering to overt capitalism, even I think clearly Chinese policies changed materially since the late 1970s and very positively at many levels. But just if you have that sort of state-led angle still there, that's always going to create a few issues, certainly as an economy matures. People get older and other requirements are to be seen. Be interested to see how Xi Jinping decides to play some of those angles. I'm kind of pleased to see that they haven't done the easy route, which is either print more money or just raise debt levels with the hope that everything's going to work out. I think there has to be what I would call a capitalist rationale there beyond what we've seen so far in recent Chinese capitalism. I think it's coming. I say Alibaba, I think, is a very good indicator of on that front. That'd be my view. But we shall see on that front. And in terms of upcoming matters over the next couple of weeks, well, I guess I'm intrigued to see what, as we get to the next bout of central bank meetings, if I was the Fed, if I was the Bank of England, if I even was the ECB, the last to start to raise interest rates, I would be chilling here and not raising rates further. Going to be fascinated to see the discussions at various areas such as PMI services numbers. They're upcoming next week. G20, as I've mentioned, you've got mid-September. Interesting meeting there. Of course, that's going to be good. General geopolitical angles, but also general interesting updates from as companies come back to work, as people generally come back to work and have lots of corporate updates, which are not actually centered on a quarterly earnings season, but just general, what are our plans for the rest of the year? And hence, what are people thinking about the run to Christmas, how the rest of 2023 is going to play out and the like. As I say, kind of fascinating that the fear and greed index is at neutral at the moment, or neutralish at the moment. That tells me that for the active investor, that's where you'll find the best opportunities. So in some senses, lots of a big moment, lots of sources of potential change and related, but my mindset remains very akin to how I started this year. The best returns come from equities. I think probably bond investors will make a bit of money. It doesn't make sense to have a huge amount of cash. It makes sense to have a little bit of gold and proper alternative assets. The most important thing, though, is apart from continuing to play the investment game and thinking about it and researching it, is to be a proper pucker active investor, really. That remains the key for anybody who wants to perform. And I know certainly some technical analysts will probably be thinking, yeah, the technical respect is the key here. But as you know, I'm a fundamentalist, so I'm afraid technical investors are probably not listening to this in any case. But fundamentally, it still seems to me kind of opportunistic out there. You just got to be careful and aware. You know, I guess that probably is not actually going to change that much for the 2020s. The composition of your portfolios undoubtedly will, but I think not the sort of the broad range of style. Certainly matters that I've learned over the last 25, 30 years. Some of them are really coming to fore now, which I feel really excited about. And certainly when I think about my own personal pension fund allocations over the rest of the 2020s into the 2030s, as far as I can think going forward, I'm excited. And that's the key. So that positive kind of outcome conclusion, if you like, I'll bring this podcast to a close now. Looking forward to coming back next week with a second part of a literary review that I started on the last podcast. We'll finish that up, but also started talking about some further insights on the world, be it corporate, macro sector, or whatever that have occurred over the interim period too. So thanks so much for listening. Obviously, as always, come back with any questions or insight requirements or anything else through the usual means. And we'll speak again soon. Thanks for listening. Bye-bye.